The primary business of a bank is making loans, and so how a bank prices its loans is an important question. The interest rate spread is the difference between the rate on the loan and the cost of raising funds. For example, if a bank earns 8% on its loans and pays 6% on its deposits, this would be an interest rate spread of 2 percentage points. The difference between the two has to cover the administrative costs of running a bank and also the profit for the owners of the bank. While the bank would like to charge as high of a rate of interest as it can, it is limited in what it can do, since borrowers could go to other banks or find other sources of financing. Another issue is the risk of default. Borrowers that are riskier need to be charged a higher interest rate to make up for the fact that they are less likely to repay the loans. That is, the higher rate paid by the ones who do repay their loan makes up for the ones who don't. A common way to approach loan pricing is to start with the base rate for the best borrowers and add various premiums to that. For a base rate, banks often use a prime rate or a short-term market rate, such as the Fed funds rate, the Treasury bill rate, or LIBOR. To the base rate, various adjustments or premiums are added. A bank might add to the interest rate if the borrower has a greater chance of default. It might add a premium if the loan has a longer term to maturity. It might add a premium for competitive factors, that is, if the borrower doesn't have very good alternative ways of raising money. As an example, we could imagine a bank charging a 3% base rate to its low-risk customers, then adding an extra 2% default premium because the borrower has a higher chance of default, and then adding 3% maturity premium because the loan is for a longer period of time, and then finally adding 1% because the borrower probably won't leave if they were charged the extra 1%. Adding things up, the borrower would be charged 9% on the loan. There are other ways that the bank can affect the terms of the loan. Collateral is an asset that the borrower pledges to the lender, so that if the borrower does not repay the loan, the bank can seize the asset. This reduces the risk for the bank, since the borrower will not want to lose their asset, and it at least gives the bank something if the borrower defaults. Compensating balances is when the borrower is required to hold an account at the lending bank, typically in a non-interest-bearing demand deposit account. This gives the bank a cheaper source of funding since the account does not bear interest, which increases the net interest rate for the loan. It also allows the bank to better monitor the payment activities of the company if the company uses this as a transactions account. Matched funding, which is sometimes called maturity matching, is when a bank uses funding of the same maturity as the loan. For example, pairing a 2-year CD with a 2-year loan. This reduces the bank's risk since they know they will not need to return the funds to the depositor for 2 years. In a maturity mismatch, say funding a 2-year loan with demand deposits, the depositors could pull out all their money after a year, and then the bank would need to find that money elsewhere. Since part of the business model of a bank is maturity mismatching, offering relatively liquid deposits to make liquid loans, there is a limit to how much they can use matched funds. A basic principle of finance is that there is a risk-return trade-off, that people do not like risk, and so if they are going to make a risky investment, they need to be offered a higher average return. The way banks do this is by assessing the credit risk of an individual and either charging a higher interest rate to someone who is more likely to default, or maybe not making the loan at all. For example, a bank may make 100 loans that have a default rate of 0%, that is, there's no risk, at an interest rate of 5%. When faced with riskier loans, say 100 loans with a default risk of 10%, they would charge a higher interest rate, in this example 8%. It is important to note that the bank will not earn 8% on all of these loans. 10% of the loans will default and they will earn 0. What matters is that the 90% that don't default pay enough more to make up for the 10% that do default, and so provide a premium to the bank for the uncertainty it faces. Obviously, borrowers will want to look like good credit risk so that they will be charged a lower interest rate. However, banks only have limited information. They know less about the borrowers than the borrowers know about themselves. This is called asymmetric information. One side of the transaction has more information than the other. Because of this, banks put in a lot of effort to try to predict the default risk of their borrowers. While in our simple examples, we often assume a default rate, banks are in a situation where they have to use limited information to judge default risk. What things do they look at? The 5 C's of credit is a list of 5 things that banks pay attention to. Character represents the willingness to pay, or more practically, the willingness to default. If the company was in tough times before, did it default on the loan, or did it find other ways to make sure the loan was repaid? Capacity represents the financial ability to repay the loan. Will the company have a steady cash flow in the future that it can use to repay the loan? Capital represents the wealth of the borrower. If I borrow money from a bank, do I have other financial assets, such as long-term investments, that I could use to repay the loan if necessary? Collateral are assets that I pledge that the bank could take if I don't make the loan, which reduces the risk for the bank. Conditions refers to the economic situation. Is the economy booming so that my company will generate plenty of profit to repay the loan? Or is the economy headed for a recession, so I might find myself in financial trouble? One way of evaluating these factors is to have a person go through each of these items. However, that can be slow and expensive. An alternative approach is credit scoring. Credit scoring takes information from an individual's credit history. When did they borrow? How much did they borrow? Did they repay the loan? And then uses a computer algorithm that summarizes the default risk. The higher the number you have, the better your credit history, and the less likely you are to default. Credit scoring has the advantages of being quick and low cost, and so is very common, particularly for consumer loans where the credit history is not too complicated. There are other things that banks do that do not involve making loans. Often, banks charge fees for these services instead of making money through interest rate spreads. Correspondent banking is when one bank offers banking services to another bank, often a larger bank offering services to a smaller bank. Trust operations are when a bank manages assets for a wealthy individual or a trust. You will also hear this called private banking or wealth management. Banks have also been increasingly involved in selling other financial products to individuals, such as offering mutual funds, brokerage services, or insurance products. This offers convenience for the customer since they can go to one branch office to obtain multiple financial services. However, it's important to remember that these other investments offered through the bank are not covered by deposit insurance. Certain activities of a bank do not immediately show up on their balance sheet. These are called off-balance sheet items. For example, if a bank makes a regular loan, the loan will show up on the asset side of the balance sheet. However, if a bank makes an agreement to lend money to a customer in the future, this will not show up on the balance sheet until the bank actually lends the money. A loan commitment is a promise by the bank to lend money if the borrower requests it, subject to various conditions and limits. This option is beneficial for the borrower since they now know the money will be there if they need it, but they won't have to borrow it if they don't need it. Since the bank may get a fee for offering this commitment, it is one way of generating revenue. However, the commitment itself is not shown on the balance sheet. The balance sheet underestimates the amount of loans that the bank might have. A line of credit is an agreement where the customer can borrow up to a predetermined limit on a short-term basis. Revolving credit is a legal agreement where a bank agrees to lend up to a certain limit for a period exceeding 1 year. A letter of credit is an agreement issued by the bank that involves 3 parties: the bank's customer, and a beneficiary. With a commercial letter of credit, a business that is buying some merchandise will arrange for the bank to pay the seller of the merchandise once the terms of the agreement are satisfied. A standby letter of credit is where the bank promises to pay the third party if the customer does not meet the conditions of the contract. In other words, the bank guarantees payment. In these cases, the creditworthiness of the bank is being substituted for the creditworthiness of the business. Derivative contracts are items such as options, futures, and swaps, securities whose value depends on or is derived from some underlying asset. Derivatives can be used by banks to reduce risk. For example, if a bank has a payment made in a foreign currency, it can take an opposite position in the foreign currency futures market as a hedge. However, a bank can also use derivatives to speculate in a way that increases their risk. For example, by betting that exchange rates will move in a particular direction. The use of derivatives by banks is a controversial topic in bank regulation, because derivatives can be used to either increase risk or decrease risk, and it can be difficult to determine which case it is from the outside. Securitization is when loans or other items are bundled together as a bond, and then the bond is sold in markets. Mortgage-backed securities, which bundled together groups of home loans, which were then sold to other investors, are an example of this, and were at the center of the 2008 financial crisis. The value of these bonds, which depend on the value of the underlying mortgages, turned out to be quite risky, even the ones that were thought to be low risk at the time. Related to this, banks can generate fee revenue by being a loan broker or originator. For example, a bank with branches in a fast-growing residential area can sell mortgages to home borrowers and collect a fee, and then move them off their balance sheet by selling them to be bundled in a mortgage-backed security. In addition to looking at a bank's balance sheet, we also want to look at their earnings on their income statement. Bank income statements have the same general structure as other businesses. Revenue minus cost equals earnings. But revenue and costs come from different kinds of activities, so it's worthwhile to define some terms that mostly show up on the income statement of banks. Interest income, which is the interest generated by loans, is a major source of revenue for banks. Interest expense is interest paid out on deposits and borrowed funds. Net interest is the difference between the two. A bank that earns 8% on $10 million of loans and pays 5% on $10 million of deposits would have income interest of $800,000 and interest expense of $500,000, and so net interest of $300,000. Provision for loan losses is an expense item that reflects expectations that some loans will not be repaid, and so the value of the assets on the balance sheet is decreased. Finally, to find bank earnings or net income, we need to add in non-interest income, the revenue the bank receives from non-lending activities, and subtract non-interest expense, which is primarily the costs associated with labor and physical capital. When evaluating bank performance, we are interested in a number of different questions. One question we might be interested in is the bank well managed? For example, what kind of return is it getting on its assets, and what kind of risks is it taking? We also want to know if the bank is profitable. What kind of return is it generating for its owners? In other words, what return did the equity investors get? If we are thinking about investing in the bank, we would want to look at its earnings to determine a fair price for the stock. We know there are a number of different financial ratios we can use to evaluate companies. One ratio that is particularly important for banks is the return on average assets, since a bank's primary business is managing the asset side of the balance sheet by making loans. This ratio is calculated as net income divided by average total assets. You can get a higher return on average assets by having higher lending rates or lower deposit rates. But at the same time, the bank needs to be concerned about asset risk. If the bank gets the higher lending rate by making a lot of risky loans, it may not be worth it. Also, if a bank increases the amount of assets it has through increased leverage, the extra risk from doing this may also be a concern. Another important ratio is the return on average equity. This is calculated as net income divided by average equity. This measures the rate of profitability for the owners of the bank.